Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Thanks for joining me. On this episode, I interviewed Jesse Bobrowski, who is the Vice President at Calvert Home Mortgage Investment Corp, which is also known as a MIC. Calvert is a private fund where investors get to buy shares and earn money through the interest and fees that Calvert obtains through their mortgages. On this episode, we talked about the expected annual returns for people that invest in their funds, what type of properties Calvert loans against, and then Jesse breaks down who can invest into their fund, their redemption model, and their payouts, their payout model. And then we later talked about how they determine the share price that investors will be buying into with regards to their fund, why they borrow money from banks in addition to the money that they raise from their investors, the rates that they charge investors, and we broke down a little bit about their $20,000 down payment program, which some of you guys may have heard of. We actually had Jesse on a previous episode where he broke down that program, so you guys can go back in time to listen to it and check it out. Just want to remind you that if you do enjoy this podcast, make sure to leave us a 5-star review on the Apple Podcast platform, because that helps us grow and get the word out there. And then if you have any interest in finding out a bit more about the multi-unit properties that we're investing in, we're targeting 15-unit buildings in the Niagara region. So if you'd like to take part in investing with us, make sure to reach out. You can email invest@welloff.ca or DM me on Instagram. My handle is welloffx. So there you go. Enjoy the episode. All right, I'm here with Jesse, who works with Calvert. A lot of you guys have heard of Calvert in the past. Today, we're going to talk a little bit about the flip side of private financing. In the past, we've talked about some of your programs for investors that are looking to purchase property. Today, we're going to talk a little bit about people who have some cash and that want to make some returns. So welcome back to the show.
Brilliant. Well, thanks for having me, and thanks to your listeners for joining us this morning or today or whenever the heck you're listening to it.
Yeah. So for the people that may not have heard of Calvert, do you want to tell them a bit about the company, what you guys do, even though I kind of summarized it just now?
Yeah, sure. So I'll try to highlight this as broad as possible. We are a mortgage investment corporation, and we are focused on serving clients that need short-term residential mortgage solutions. We lend a lot to real estate investors who buy, renovate, and sell, or buy, renovate, and refinance properties. We do a lot of bridge financing. We do some debt consolidation financing, where we consolidate consumer debt and put our borrowers on a track to get refinanced through the banks. We also do equity takeouts and sometimes short-term purchases, even for instance, new to Canada, where they don't have established credit or established income, yet they have capital, want to buy a house. We'll support them for that. So that's what we do for our borrowers. And through doing all that, we lend our money out. We get paid fees and interest. It goes into a fund, and we earn investors a return. Our goal is to provide an industry-leading risk-adjusted return. So firstly, we focused on risk, preserving capital, and creating a steady stream of income, and in turn, return for our investors. Our goal is to return 8 to 10% annually. Over the 40 years we've been doing this, our average return has been 13%. Over the last 10 years, which is more relevant, our average return is 9.96%.
Mm-hmm. Okay. So just to touch on a few things that you had mentioned here, one of them, you said you basically only do residential financing. Does that include apartment buildings? So that you have 20 units and it's all residential. Is that something you guys will look at?
Yeah. So residential is our focus. Usually it's 4 units and less, but certainly we've helped clients with multi-unit. We like to keep our loan amounts $2 million or less.
Okay.
Our average loan amount right now is $420,000, give or take. But what we're seeing is, based on our focus of residential, and really it's mid to lower half of the market, Canada, in most urban centers, which is where we lend, by the way, we focused on larger urban centers. One of the key themes and trends is that there's simply not enough housing stock for for what the demand is. And that issue is especially acute as it relates to the lower end. So the multifamily stuff, there is a real demand for that and a real opportunity to help investors buy underperforming or really rundown assets, put some work into them, stabilize rents, and then refinance us out. So we do multifamily. And by the way, we do the odd commercial loan. Like I think right now, out of our 320 million, we might have 4 or 5 million in true commercial loans, commercial condo bays, or standalone centers. But our focus again, short term, residential, in large urban centers, mid to lower half of the market. Yes, we'll do some higher end stuff, but again, we try our best. We've built our business and risk parameters around that model, and so the bulk of what we do sticks to that.
Okay, sounds good. Thanks for clarifying that. That gives us a pretty good overview of what you guys do, what your focus is, and the investors that you're looking for and the types of properties. Now, for somebody who has some cash laying around, let's say they have, I don't know, 300,000-400,000 grand, or maybe they have access to a HELOC where they're paying 4.5% interest, let's just say, what can they do to earn a return? How does the process, what's the process like to work with you to start earning a return on their money?
So firstly, we look at the investor and qualify them. Because of how we're regulated, combined with our business model, we only accept money from accredited investors. And the standard definitions to be considered accredited investor are either earning an income of over $200,000 as an individual or having a net financial assets above $1 million. So if you meet those standards, we will look to work with our shareholders. We want to ensure our shareholders understand the risks associated with investing in us, and also understand our current operations and our vision for the future. And if they align with us with that, then we'll look to accept their capital. We don't want them to ever have too much capital with us. So rule of thumb is 10% of net financial assets. We don't want to see them exceed that. Also, you mentioned borrowing to invest with us. We don't like to see that either. If you don't have the liquid capital to invest, we may not be the right investment. And the reason is we're versus the capital markets, we're illiquid, right? Like you can only access redemptions once a year, May 10th. So your money is stuck with us. And more and more, we're looking to partner with individuals and fund managers who are looking to provide larger sums of money. It's more efficient for us, and also usually there's a higher level of sophistication that comes with that type of investor. So it allows us to work better with them. Now, I don't want to discourage individuals to reach out who wouldn't be able to invest into the millions at one time with us, because we built our business off of relationships and serving those who align with our business model. So, for example, we work with a lot of mortgage brokers. We work with a lot of lawyers, and they may not, they may be putting tens of thousands or hundreds of thousands in with us at a time. But the reason that they're wanting to work with us is that they've seen under the hood. They've seen how we operate with our borrowers, our processes, how we manage risk, and we treat that as a real compliment. So, of course, we're going to look to accommodate their money, but for the most part, we're looking for those really high net worth individuals where they'd be placing $1 million plus at a time. Although we still have hundreds of investors who have, less than 250 grand with us. So did I have I properly hit on what you were asking there?
Pretty much. Okay, so I've got a few questions for you. Let's say you have somebody who puts in 250, another person puts in 300, 400,000, and you get that borrower that needs 800,000. Are you you're just taking that money from multiple people and lending it out to the investor that's purchasing a property, or how does that work exactly?
That's a really good question. So we are a fund, one entity. When you become an investor in us, you are a shareholder. So you buy shares, and now your, let's say, $250,000 is in the fund with the other 320. That 250, the shares are spread out over the 930 properties that we have lent on. So you're not exposed to a single property; you're exposed to the whole portfolio, and you're simply a shareholder along with our other right now 400 plus shareholders.
Now, how do you determine the price of the share in this situation?
Awesome question. The price of the share is based off of our net asset value. Our net asset value was calculated quarterly. We have a very specific calculation on how it's done, and that's outlined in our financial statements every quarter, which are our audited financials and reviewed by our board of directors and approved by our audit committee. But regardless, net asset value is basically 99.9% of it is the money we have out in mortgages. The other small bit will be, property, plant, equipment. We have some proprietary intelligence and systems that have a value, but the bulk of our net asset value is the money we have out in mortgages. And then you just divide it by outstanding shares. The share price itself won't move much because of that. So, for instance, our share price right now is $103.20 some odd cents. It hasn't moved less than 102 or more than $104 per share in the last 13 years. What moves the share price is when we suffer a loss or a gain. We suffer losses when we have to sell a property in foreclosure. We see gains when we own a property through foreclosure and sell it for a premium. That happens from time to time. We'll do a little bit of work to it. Maybe we'll rent it out and hold it for a bit and then sell it at a premium. So those are really the two mechanisms that will really affect our share price. But typically our shareholders, they should not get rich or poor from the share price. But it should all happen from our annual return.
Okay, so that annual return, is that paid out as a dividend, or how exactly is the investor getting paid if the share price isn't really changing too much?
Yeah, they're getting paid out as a distribution. Okay. Not to be confused with dividend, because the distribution of any MEC is interest income. So the shareholder on an annual basis is paid out basically our net income. As a mortgage investment corporation, we have to pay out all of our net income. We're not allowed to keep retained earnings. Mm-hmm. So every year, we earn all of our interest and fees. It comes into the fund. We incur all of our expenses, come out of the fund, and we push the net to our shareholders annually.
Now, what kind of expenses do you have as a MIC?
The two biggest expenses are our people. So employees and management, salaries and bonuses. Our other biggest expenses are cost of capital. Out of the 300 and I'm going to use easy numbers, 330 mil, we're borrowing 130 of that from the bank at around prime plus 0.5%. That's a big number, especially as interest rates increase. So those are our two biggest expenses. Then we have everything else: overhead, technology, systems, utilities, you name it. We have all the expenses a fund would have. We also employ, we also use consultants. Our board members earn an annual fee. So everything, and that's all. What's really cool and unique about us is that we are one entity. So all of our expenses are captured within Calvert Home Mortgage Investment Corporation. All of our earnings are captured within that.
Mm-hmm.
So our shareholders get to see the whole picture. Whereas the bulk of our competitors, they will have two entities. They'll have a fund in which the investors make their income, and they'll have a fund manager in which the management team will charge the fund 1 or 2% to manage it. They may earn some fees. They'll pay some expenses out of it, some of expenses out of that. So it's not as transparent as the model that we have.
Mm-hmm. Got it. Okay. You mentioned that you guys are borrowing 130 million out of the 320 million that you have out in loans. Why are you borrowing from the bank or from a lender?
We're borrowing from the lender for a few key reasons. Firstly, for the benefit of the shareholder. So right now, our average interest rate that we're charging our borrowers is around 10%. We're borrowing from the banks at, let's call it today, prime plus 0.5. So what's that? 5 and a bit percent.
Yeah.
So our investors are in that spread.
Okay.
So we're able to lever up the returns based off of that.
Yeah, it's still a little bit confusing. Like, I'm just trying to wrap my head around this because an investor is putting their money in their cash,
Yep.
and then you're loaning that cash out to a borrower for a spread. So then why would you still need to borrow money from a lender in addition to the money that you're collecting from investors?
We don't have to, but we do because, so here's an easy way to look at it. Or here's an easier way to look at it.
Sure.
There's a cost of capital, right? So we're always looking at, we refer to it as WACC, weighted average cost of capital.
Okay.
And the more we can be efficient with our cost of capital, the better pricing we can give to our borrowers, but more importantly for the business, the higher return we can give to our shareholders.
Okay.
So if I take on, let's say that I needed $20 million of new money.
Yeah.
To because we have an opportunity to lend to more borrowers.
Right. I see.
I would rather take the bank's money at 5% if it's available to me, than go to George and take his 20 mil because then I got to pay him my net return, which again averages around 10.
Got it.
So if I can, and again, the bank has covenants and we also don't want too much leverage. We don't want to be too beholden to the banks, but all things being equal, if we can, we're going to go to the bank and say, yeah, you give us your 20 mil at 5%, and then the returns to me, and this is being selfish because the bulk of my net worth is in the fund. The returns to me are going to be levered up. Why invite George in on this great business that we made unless we have to?
Yeah. Okay, so it makes sense. So you're basically taking advantage of bank leverage to increase the amount of capital that you have available to loan out to more people because you're making a good spread considering the rate that you're getting from the lender.
Yeah, increase the amount of capital and decrease and also increase that spread we can get to our shareholders.
Yeah. Okay. Makes sense.
A couple other benefits of using the banks is it's a much larger pool of capital. They can grow as we grow. I don't have to continuously go out to the market and raise a bunch of new money. Just have to go out to our bank partners and say, hey, here's our plan. Here's how we're working. We plan to ask you for another 50 million next year. And as long as the business is running well, we're probably going to get that approved.
Okay. Makes sense.
What's also great about the banks, I'm putting my shareholder hat on now, is that they provide an additional level of scrutiny on us as a fund and fund managers. So we have our auditors that are looking at our financials and reporting. We have our board who is looking at our strategy and governance. And then we have the bank who's looking at our underwriting and processes and how the business is running. So when I put my shareholder cap on, it's just another really well-educated, sophisticated resource looking at our business and challenging us. Are we doing things right? So I love it for that reason too.
Yeah, makes sense. I know maybe I'm just not understanding this, but I'm going to ask you anyway, and you may have already covered it, but you said that the average borrower is paying 10%. And you said earlier that the average return for investors is between 8 to 10%. Over the last 10 years, you've averaged 9.96%. So there doesn't seem to be a spread when I just say it like that. So what am I missing here?
Remember that we're borrowing from the bank at 5.
Yeah.
So if right now we have 130 mil from the bank that's lent out in an average of 10%.
Yeah.
We're only paying them 5.
Okay. So there's a
So
5% spread.
that's a big spread for over the year.
Yeah.
But there's also, going back to our model where we're one entity, we earn fees. The average fee that we earn is 1.2% from our borrowers.
Right.
And we're lending out on average, we'll lend out ballpark this year 420 mil.
Okay.
So that's another 5 million of income that's going into the fund that we can pay expenses and generate that return for our shareholders. Okay. So those two things are what allows us to really, we're going to earn this year. This year we're on pace to do a 13% return. So because of how well the business is going, the volume, all those things combined, we're able to provide a return higher than our average interest rate.
Okay. We're at a time where we've seen some interesting changes. Last year, I'm sure you guys, things were looking a lot different than they are now because the market has taken a bit of a dip and things have adjusted. What impact has that had on your business, on just the kind of returns that your investors might be looking for or expecting?
So yes, things have changed significantly. In terms of our shareholders, what they're looking for is firstly security, so protecting their capital. The commitment or the commitment that we've made to them to do our best to provide an 8 to 10% return remains steadfast. So they're happy if we're doing that. Their expectations have not gone up, at least yet. Their expectations have not come down, at least yet. There's a lot of dynamic always in the investment world. So right now we're seeing the stock market in bear market territory where some investors have lost over the last year. Yet the fixed income market, as it relates to government bonds, GICs and the like, are creeping up. Like you can now get basically a 5% guaranteed, which is amazing. So the sophisticated investors are just weighing the opportunities, understanding what their pros and cons are, and looking to deploy money where they see best fit. Where our book is at, being residential mortgages in major urban centers, our loan to value is 58%, and returning what we're returning is not difficult for us to raise capital. So I guess investor sentiment continues to remain high for our program. But definitely it's super dynamic, and we always have to be paying attention to these things. We were fortunate that a year ago, when the market was going up at the pace it was, we were looking at it and saying some of this is false exuberance created by really inexpensive money. So we made underwriting decisions and parameters to ensure that we're protecting against the downside. Because if we were going, if we were lending money out to match that exuberance, we today may be facing an instance where we're seeing a lot of loan losses. We're seeing a lot of foreclosures. We're seeing a lot of people in trouble. So far, we're not. We expect that to go up, though. Like for the last 2 years, we've been near all-time lows as it relates to loan losses and delinquencies, just because the market is going so well. But as the market turns here, that will normalize, or maybe even go a bit higher than normal. Although the business itself has we're fortunate that there's a lot of buffers in place to absorb some of that.
Yeah, for sure. Just to dive in a little bit into the details of what you guys are loaning. I'm not sure if you know the number off the top of your head, but obviously you guys have a program that's pretty unique, or not many other lenders offer, where you do $20,000 down payment and you will fund the remaining amount of the purchase for, I believe your rates are currently at 16.5% plus a 2% lender fee. What percent of your business comes from that program versus maybe like somebody who's putting, I don't know, 40% down and getting a private first through you?
So that 20 grand down program, those numbers remain the same today, although we'll likely have to increase it a bit. We've only increased 1% our rates. Well, we've seen as of today a 3.5% increase since March.
Yeah.
So going back to that, that program starts at 20 grand down.
Yep.
And then as the real estate investor, this is a flip program. So the reason they could buy with 20 grand down is that they're buying, renovating, and selling or refinancing. So they're putting capital into the property to decrease our risk and make profit for them. Mm-hmm. So we're only lending to our borrowers if they're increasing the value, making a profit, and our loan to value is at or lower than 80%, loan to after repaired value.
Yeah.
So the 20 grand down is available at 16.5. As the borrower puts more money down, reduces our risk, the pricing goes down. Right now, the lowest pricing that we have offered is 8.9 if you put 25% down, and it scales in between. On that product, lending to real estate investors, 75% of the mortgages we do today are lent to them. So out of the 420 that we'll lend, 315,000 will be to real estate investors this year. And we believe that is an area of the market that will continue to grow and will continue to support. The reason we believe that is in Canada, especially in major urban centers, there is a major lack of residential housing. These flippers are buying residential housing that is run down, that the market doesn't want. They're rehabilitating it and getting it to the market. So they're basically creating housing stock. And based on what we anticipate for demand, immigration to Canada, that model will continue to be very helpful for the Canadian residential market as well as the Canadian economy. So we hope to double down on that. We hope to build out more tools, better products, better service for real estate investors, growing our current market, which is Alberta and Ontario, looking at BC in the next year or so, and really serving Canadians in real estate investing and purchasing those rehabilitated properties.
Yeah, just to make sure I understood correctly, you're saying 70% of your money loaned out goes towards that $20,000 down payment program.
It goes towards the flip program. So the flip program is $20,000 down all the way to 25% down.
Got it.
So 75% of the lending we do is into that program.
Okay, and the other 30%
of that, pardon me?
Sorry, go ahead.
Going back to the 20 grand down.
Yeah.
Right now in this market, most investors are wanting to put more down because usually they use the $20,000 down when there's an opportunity to do a lot of volume and the market is a bit stronger. Because it's not, they're putting more money down and buying their rate down. So right now we probably only have out about 7% of our book is on that $20,000 down program. Mm-hmm. So anyhow, going back, you were asking the other 25% of our book?
Yeah.
That's going to be short-term mortgages on equity takeout, debt consolidation, short-term purchases where, again, we talked about new to Canada. They come with capital, education. They don't have the history. They want to buy a house. We'll support them on that.
Got it. Okay. That's good to know. Just wanted to return to something you mentioned in the past. Well, you mentioned it like a while ago, actually. But you said redemptions are done once a year. Can you elaborate on that? You said the money is kind of stuck in the fund, except for that once a year redemption period.
Yeah. So our year end is February 28th. And if you invest anytime through the year, you're into the fund and you cannot get a redemption until after the year end. So what happens is all of our redemption money is paid out on or before May 10th every year. And the reason that is our year end is February 28th. Auditors come in March. We have our audited financials ready for review early April. Our board meets late April to review and confirm the numbers. And then we send out our audited financials, and then all the money flows that May 10th date. Once a year.
Are you expecting this year to have a larger redemption rate than previous years because of the turn in the market?
We're not seeing it yet. So our investors can request their redemption anytime throughout the year. They just won't get it until May 10th.
Right.
Right now, we have no money queued up for redemption.
Got it.
Certainly, depending on, usually investors will look for redemption in the times of big downturns where they need the capital. And most of our investors aren't seeing that, right? Like the equity markets are down. There's nothing drastic. There's nothing really, really unique about risk in today's market. So we're not anticipating higher than average redemptions. Our average redemption, by the way, is around 2%. Again, going back to how much rigor we put into knowing our client, ensuring that they align with us, ensuring that or doing our best to look for clients that want to grow their investments as we grow. So we've done a really good job at those relationships, and because of that, we typically see very low turnaround of money.
Awesome. Well, I think we touched on a lot here. There's a lot for the listeners to digest. Do you feel like there's any last minute things you want to touch on? If not, then what's the best way to reach you and get started on investing with you guys?
Yeah. So there's for sure a few other things I want to touch on. We're definitely not the only option out there. So we want to make sure if you are interested in investing in mix or alternative lending, to do your research. When doing your research, some key things to look at will be what loan to value is the fund lending at, who is the management team, what is their experience, how long has the fund been around for. You have a lot of funds that are less than 10 years old. They've only lent in Ontario or BC where markets have only gone up. They may not have dealt with a downturn in the market. How will they deal with that? Also, you'll want to look at where they're lending and what they're lending on, right? Like lending on speculative land has a lot different risk than lending on single family houses. Look at what the model is and what their return history has been. Also look at how much of the management's own capital is in the fund. I love that I have the bulk of my money in the fund. My advisors say it's risky to be over concentrated. And again, we don't permit our shareholders to be over concentrated. But as an owner, I really believe in what we do and see a long history of setting this business up for a great risk adjusted return. So the listeners, if they want to invest in lending, they should do their research and understand the options. And I just gave some ways to poke and review and do your due diligence. To get a hold of us, you can Google Calvert Home Mortgage. We have a great website, chmic.ca. Unfortunately, on that website, we don't do any advertising for shareholders. So if you actually want to become a shareholder, reach out to me via email, Jesse, Jesse, at chmic.ca. You can always call me, 403-617-9931. Check us out and follow us on Instagram. A lot of great content there. Contact info's there. You can DM us, make it really easy for you. Those are the best ways to get a hold of us.
Awesome. Jesse, that was great. Thank you. I think you really opened my eyes to how you can invest in another way, because the only way that I've known of to do private financing would be to speak to a mortgage broker, and then you have to vet the property, the person that's borrowing, do all that yourself. This is a bit of a different way to like just own shares and get kind of, you have the track record of the annual return. So it's a lot easier for certain people to invest this way and maybe safer as well.
Yeah, you gotta, and a lot of people get into it that way. One thing you didn't mention is when you're investing on a one-to-one mortgage, you're fully exposed to that one mortgage.
Yeah.
So if it fails, if that loses money, you lose money. Whereas when we lose money within our fund, it's distributed out through 900 and some odd other properties and a bunch of shareholders. But definitely the professionally managed side of it is an added value to our shareholders. But yeah, thanks for having us on, and always happy to educate others and your audience. That's a big goal of ours, is to educate others for their personal and financial success.
Sounds good, Jesse. Thanks again for your time, and I look forward to staying in touch.
Awesome. Thank you.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.